Mark Roberge is the founding CRO at HubSpot, co-founder and managing director at Stage 2 Capital, and the author of The Science of Scaling. And he's seeing a new problem across go-to-market teams. Everyone is telling him.
Good news, we are so AI enabled in our sales team. And I'm like, how do you know? So it's we got to measure it.
In today's episode, we dig into quantifying the impact of AI on your go-to-market efforts. And Mark reveals why adding more AI tooling often fails to close deals any faster.
The vendors are highly motivated to accelerate sales actions with AI. The buyers are.
We also explore the concept that every board wants to hear, but almost every operator gets wrong. How Mark is currently disappointed by the state of AI in go-to-market and the hyper-specific lever that can literally double a team's sales results. Welcome to Topline. Hey everybody, it's Sam Jacobs. Welcome to Topline. I'm joined by my wonderful co-host, AJ Bruno, the CEO of QuotaPath. Asad Zaman is off doing adventures. He's not joining us today, but we are joined by a very special co-host and guest, Mark Roberge, friend of the pod, general partner and founder at Stage 2 Capital, founding CRO at HubSpot, author of The Sales Acceleration Formula, and also author of the new release, The Science of Scaling, which I can attest that I have read start to finish. Mark, welcome back to Topline.
Wow. Sam, got to bring you around. Thank you. Appreciate the opportunity to fill in Assad.
Here's my takeaway to prove that I read the book. My favorite part is the leading indicator of retention. You make the good point that oftentimes retention data comes too late. And if we're trying to calculate unit economics and we don't know what retention is, we need to work backwards, especially if we're trying to scale from a leading indicator of retention and drive the results of our onboarding and our customer success organization towards that. And I thought I think about that all the time that I talk about unit economics, because
Thank you.
I get people asking me, how reliable is LTV? I'm like, well, Mark would say it might not be very reliable at all. We need to focus on what the leading indicators are.
A+, Sam, on that one. Kind of B- on the proof that you read it cover to cover, because that's in the first part. It's the first, I think it's the second chapter.
All right,
so if you could quote me the last chapter.
The concluding scene was a woman. It was a woman that had gone public or something. And I will tell you another detail. Some of the descriptions and the metaphors you use are extremely literary in a way. I can't remember all of them, but I wanted to text you a few times because they're he felt as sad as the darkening clouds over the fall sky. It's okay. This is where he's going.
I don't know if I should say this.
No, you have to say this.
Those are all the AI. That's all ChatGPT.
Well, it obviously those are my original thoughts coming from actual board meetings, and everybody reads those fictitious. I put those things in there because it just makes, I think, the book more interesting. It makes it more accessible. And you guys have all been in, it's in 75 board meetings a quarter. So all these stories, all those thoughts are original, but I'm not a professional writer, and I may have relied on, just like writers in all the history of the world have relied on help. I may have used some help from some amazing literary authors. Now, yeah. I didn't use a human helper. I wrote the book, the whole thing, every word, right? But AI is very powerful right now, and it can help someone who scored less than 500 on a verbal SAT sound like an actual amazing novelist. So it's great.
As Mark knows, I mentioned this, I think, the last time, which is we did a book club as a management team and read Science of Scaling. My favorite part of this is not how I'm earning my A+, is I find it interesting the text size between chapter to chapter. Sometimes it'll go from size 24, and then it'll go down to size 10.
Oh my gosh, really?
Yeah,
Hey, Wiley, what's up?
It keeps you on your toes. Wiley does a good job of keeping you on your toes chapter to chapter.
All these publishers charge a lot of money. You'd think, come on, let's go. Let's get
the leading indicators retention was also our favorite part in the beginning. I vibe coded an LIR for every single organization that is going to be part of Atlas and a guided flow very, very soon, upcoming.
I love that. Well, let's go. Yeah.
It was sick. We tested it at our last offsite. AJ vibe coded a good amount of the Science of Scaling book, and it is good. We did an entire hour AJ, I don't even know. We split the team up into 12. We all went into a different room for 30 minutes and played with one of your tools, came back with like what we love about it and what like the enhancements we would write. It was sick.
I took
Yeah,
all
really
of those
good.
enhancements for LI. So I picked one, which was ILR, which is the best one to like that I had furthest developed, I would say, as a framework. Took all of the feedback, put the feedback into it, and then that was from Replit, ported it to Claude Code. Myself, our CPO, and Cole, my co-founder, then imported it, and it's almost production ready to get sent over to Aaron, runs marketing at Sage 2. So I am super excited for
That's
that.
great. That's awesome.
Yeah. Super
And I
excited.
do want to talk to you a minute, a cool story from this week about the lead indicator attention, which obviously one of the principles here is like our goal as an organization is not to create revenue, it's to create value for the customer. And revenue is one of the benefits we extract from that. And I had this amazing conversation with this gentleman, Fred Reichheld, who I don't know if you know him. You probably wouldn't. He has
do
more
not.
followers on LinkedIn than any of us.
Oh,
I
combined.
was just thinking about how I don't see popular
Okay,
people
so
on LinkedIn anymore.
he
because
invented NPS.
Oh, that's so cool.
Yeah. So he's this HBS grad from the 70s.
Right. It's an HBS
And
thing. Yeah.
but also he's a partner. He's like I think he's been a partner at Bain Capital, I think, for 50 years. I'm turning 50 next week. He's been a partner at Bain Capital for 50 years. And so obviously he's like, Bain's printed money on the MPS. And we had an awesome conversation because obviously like we connect very deeply about that first principle of like we lose our way as a business of obsessing with revenue generation as opposed to value generation. And he's just like one of the best in the world. And right now his new work is he's trying to do a lot of work on referrals and quantifying referrals. And in the same way that MPS quantified product value or service value, he's like really building off of the viral coefficient, I think, movement of the PLG time, which is cool. And you guys reminded me of it.
It is funny to me that NPS, everyone likes to hate on NPS in some way. There's just some like, but if Austin was here, he'd be railing on employee NPS. He doesn't believe in it, like it's like a very no on it. But we do an eNPS and we do an NPS and we do an onboarding NPS. We measure it 3 different ways. It is a very, very hard metric. It is brutally hard because you get one passive, let alone a detractor, and it just tanks the score. And people don't realize it goes from minus 100 to 100. So you have this scale. So if you're at like 30, you're like, ugh, this feels awful.
Which I think is depending on what your benchmark is, that's pretty up there.
Yeah,
top 20% at least, like wasn't like the iPhone like 75 or something. I don't know. Like, there's 2 things I'll share there. The first one was, and I shared the story with him. It was really impactful at HubSpot with our product back in the first 10 years. What we did when, of course, we were fairly transactional, so we had thousands and thousands of customers, so we could do this. We split the customers into 6 cohorts, all of which were representative of the entire base, right? So a certain amount of big, certain amount of small, certain amount of non-tech, tech, Europe, Asia, whatever. And that allowed us to run an MPS study every month and only have to survey every customer twice a year. Do you follow me? Which was like, so every month we got to get a new score with a new set of patterns in the promoters and a new set of patterns in the because each cohort was representative of the entire base.
Yeah.
And that allowed us to learn so fast.
Yeah.
Because we're like, oh my God, this is the top 3 reasons for detractors. That's going right into the roadmap.
New statistical dynamic data.
Did we move that? Did we move it? Did we change?
Yeah.
Did we bounce that out of the top 3?
That's so interesting.
That was pretty cool. I'm trying to think of the other one on him. Oh yeah, this is an interesting debate because I was telling him about my work and I was telling him how like it's crazy how many people will say you're ready to scale when you have product market fit, which I agree with. But then I've done this in like 50 audiences this year. I think AJ, you were in one of those audiences where I'll be like, okay, cool, that's a good answer. And I'll run out in the audience and I'll have someone on the right side of the audience whisper in my ear what they think product market fit is. And I'll go to the left side of the audience and have someone else whisper in my ear what product market fit. No one has ever matched.
Yeah.
And that's the absurd thing is like, you have this term that everyone's like, it's like such like every board meeting, we have strong product market. We lost product market fit. We're pivoting to find product market fit. Good news, we have product market fit. We're going to what is product market fit? Like no one's in agreement on it.
Definition, but
and so Sam, before I'll let you chime in, because our debate was I obviously root it in retention in the long term and then use the lead indicator to measure it. He was arguing that referrals is a better measure of product market fit. But go ahead, Sam, on yours.
Well, this is Sam. I'll close my ears and then I'll whisper it. I'll whisper it back to
you. Okay.
I think the fundamental driver is retention, but it's articulated in your unit economics. I mean, payback period and LTV to CAC, it determines product market fit. Like referrals, you could be, if you're an AI native company with 30% gross margins, you could get lots of referrals, but be out of business because you can't afford to run your company. So I think product market fit is the relationship between customer acquisition cost and retention and gross margin, and average ARPU.
Go ahead, AJ. Yeah. Do you have one, AJ, or do you want?
No, I'll go because I think it's and even my own definition has changed. I would think about it in a more simplistic manner of, are your customers expanding? Do you have well over 100% NRR year over year? And the challenge we have, and like GPUs is a good example, or anything that has extreme product market fit right now. How do you, because everyone's a little bit of a snowflake, so it's easy for a SaaS era company to say, yeah, if 120% of our customers are expanding, NRR is 120%, that's an easy measure. And all of the other measures on LTV, CAC, things that are top of the funnel, I think they take care of themselves. If your word of mouth and your referral is showing that you're expanding as a business, that would be my measure.
Yeah, I like them.
In the modern world, based on your gross margin, though, because modern AI businesses don't have 90% gross margins. Like you have to make sure you can build
product market fit. So I don't think you can put gross margin in a product market fit. But I'm interested
those are very good answers. It's one of those things where it's like, where do you cut the scope of it? Because both of you are precisely correct depending on that. And so let me explain what I mean. And I think the other thing in my seat as a professor, I try to come up with things that, we mostly live in our B2B software world, but I try to also make it applicable to someone selling sweatshirts and tractors and pharmaceuticals, right? Where that gets a little more challenging. And, to your point, Sam, all the way up to Harvard Business School would agree. Harvard Business School has this thing called the Diamond Square to define a business model that includes how you sell, how you generate the service, how your cash flow formula. And they define product market fit as all that moving together, which is good. I think that works beautifully. I break those up in the book, right? I say it's product market fit, then go to market fit, where product market fit, I talk about as creating the value that you promise for the market as measured by retention in the long term and lead indicator retention in the short term, with no regard to unit economics, ignoring unit economics.
Yeah.
Then once you check that off, introducing the term go to market fit, which means now we have shown that we can consistently create the value we promise the market, but now we have to prove that we can acquire and serve those customers profitably. And so, like, again, both are right. I personally root that in my methodology just because I really like to see founders focus on product market fit in an unscalable manner and not obsessed with like setting quotas and optimal price and all that kind of stuff. And I pick those apart. And that's probably driven by just where I am as a VC. If I was a partner at Bain, I probably would do it differently because you have to operate them together.
Yeah.
Well, I think we could keep talking about this forever.
Most of the audience is like, dude, this is usually a good podcast. I didn't know this nerd was going to come on.
We're off to go. Okay, so let's head to topic number 1, which I will kick us off. So, Mark, I have a board meeting in 3 weeks, which Liz will be representing.
I'm very aware of that, AJ.
Yeah, you're very aware of our board meeting. And as I'm thinking, because we're starting to talk about it, and as I think about it, this is the first board meeting where I'm going to go into it, and I need to measure AI productivity across the organization and every part of the organization. Engineering, we've traditionally been doing it, and I would say our team is that's a whole topic by itself. I think we're 2.5 times faster than we were a year ago, but there's a lot of nuance and pieces to that. But with go-to-market teams and how executives and the boards are starting to measure them and how we should be measuring them, I'm kind of curious on some of your opinions here. And to help like get this jump started, I pulled ICONIQ's state of the go-to-market. This was in January of 2026, and they released a few numbers that are worth just discussing or thinking about as we talk about this. So they said when AI is fully embedded in go-to-market, 67% of ramped AEs hit quota versus 59% when it isn't. At the SMB, that number is more dramatic. It's actually 106% of quota attainment versus 80% if it's not. And that makes sense. AI native companies convert trial to POCs to close one at 56% versus 32% for everyone else. And AI clearly lifts top of funnel, 11% on the lead to MQL and MQL to SQL, another 8%, but barely moves active deal cycles. So it's showing up across the org, but it's every company is adopting it at different cycles, different levels. You have AI native first companies and you have different B2B. So I guess maybe for me as a traditional SaaS that's pivoting to it, how are you looking and going into these board meetings and thinking about what slides need to show up and what should they look like for us as operators?
Yeah, this is great framing. I love that ICONIQ study. It's actually already triggered some additional thoughts, and this is cool to jam with you guys because I think this is something I've been just thinking about just in the last 3 weeks, so it's fresh. Growing conviction, test it out with many audiences and boards, and let's jam on it and keep pushing it. So I think I'd root it to your point, AJ, is like I just got fed up of going to these board meetings this year, and everyone's like, good news, we are like so AI enabled in our sales team. And I'm like, how do you know? Like, you're writing emails with ChatGPT? Like, what? So it's like, we got to measure it. And that's what I've been thinking a lot about. And I think it's fairly obvious what the lagging indicator output is. And the ICONIQ study made me think a little bit about it because I was rooting it in like, you've got these, AJ, you've got certain reps who've been with you number of years. And there's certain reps that are just consistent hitters. Like they always produce 250K a quarter within a delta of 5%, right? And I think
And when they don't, your whole org feels it because you potentially miss.
And it's a beautiful, first off, that's a little totally tangential hidden gem of like, if you're trying to evaluate and diagnose whether you have a sales quality issue or something else like demand gen or macro or competitive or whatever, you look at your tenured consistent performers to see what's happening. It's one of the best indicators, and so few boards look at that.
Well, that's
Okay,
interesting.
so you got these people and like you've made breakthroughs in AI when you see those folks have a step function in productivity. If Mary had 250K a quarter for the last 12 quarters and now all of a sudden she's at 400 and you've been making a lot of investments in AI, I would argue there's something happening there. So there's a general PPR measurement. I
Would you
love
still just look at the top cohort of sellers and tenured sellers then?
I don't know. That's what your comment made me think about. I might want to shift that, and you guys can, after I finish this narrative, maybe you guys can debate and comment what it is. But like, maybe it should be percentage of reps hitting quota. It's a better, consistent thing. Because I might want to change that. I just don't. So anyway, let's think about that. Regardless, there are some fairly clear lagging indicators, outputs in sales, which we have a huge benefit over engineering of like, how the hell do we know if we're actually doing better? It's like we're producing. Now, of course, there's another piece of how do you bring LTV into that? Okay, so we can talk about that. But there's like a clear like output that we're trying to generate. Let's extract that one level back. Now, ICONIQ is focused on the close rates, which is interesting. I'm interested in that, but I have a different view that I probably like a little better, and we have to debate it, and that is the revenue velocity formula, which is a beautiful first principles formula that is rarely talked about in the industry. And you guys might be familiar with it. I'll just kind of walk the audience through it. It's the number of active opportunities that a rep is working times the ACV times the close rate divided by the sales cycle. Okay, so let's say your rep is working 20 opportunities. They close 10%, so that's 2 for $100,000 each. So that's $200,000 with a sales cycle of 2 quarters. So you divide that 2, so that's $100,000 a quarter of productivity. That's essentially what it measures. Okay, so now you've got this output of productivity that's extracted back algebraically to 4 variables. And so the question I have is, which variable is easiest to 2x? Okay, so I go through those numbers and I'm like, okay, ACV, 2x it? No. If I 2x ACV, it'll float me up into a different market potentially. So be careful, right? Close rate and sales cycle are highly dependent on buyer behavior.
Yeah.
Like
And
in
they're smaller
sales,
numbers,
what's
right?
that?
They're also smaller
They're
numbers. Like,
smaller. Yeah, but like I think that's something I'm feeling very much right now is the vendors are highly motivated to accelerate sales actions with AI. The buyers are not feeling that same pressure. So I think over time, buying processes will be dramatically enhanced with AI, but they're just not at the right speed right now, and we just can't do anything about it
and what do you
with
mean
like
by
them
that,
going
Mark?
faster. Mhm.
Let me just see if I unpack that a second, because I think that's a really interesting point just around that the buyers aren't feeling urgency around either. I don't know if it's buying well, maybe buying AI separately, but if the seller's using AI, that's a company journey. That's not a customer journey. They're not seeing that. And at the end of the day, where I see this is still where buyers are still buying from people. They still want to
Yeah,
buy and have that
right.
conversation at the end of the day.
Yeah.
And so no amount of AI is accelerating that like the actual negotiation, the
Yes.
close process
Like, let's
itself.
say like you're a large restaurant, brand, and you're looking for a new POS system. You're still buying like it was 10 years ago. Like
Right.
you're putting together a committee, you're putting together an RFP. You're like,
You're still probably buying the
Well,
POS from 10 years
let,
ago. You're still buying toast
yeah.
or whatever.
let's go to the point. I mean, we're skipping over how our organization's using AI that would deliver this increased productivity. Tell me if this is where you're
But we're
going,
gonna
Mark.
get,
So
yeah, we're
yeah,
gonna get there. Okay, so you guys can let me paint that out so that, and you guys can like pick up all the different parts. So the end output is either a PPR or a percent of reps hitting quota. The extraction back is the revenue velocity formula, which has 4 variables to it. And the one that's easiest to double, I think, is the number of opportunities that a rep is adequately working, because ACV will push you into a different market, and sales cycle and close rate is dependent on buyer behavior, which we can't change easily. But we can easily, 100% in control, change the number of opportunities our salespeople are working adequately. Now, extract that back one more, and I think that's where you get to selling time. And today's AI can dramatically improve selling time. And just for the folks that know, selling time is in a given week, what percent of that time is a rep face to face with a prospect or existing customer. And in the industry, best in class has historically been about 30%. And I see a lot of evidence that today's AI can push that to 60% plus. Now, just if you just isolate that same rep, same quota, same territory, same product, same price, same ICP, and all you do is go from 30% to 60% selling time, just algebraically, you double productivity. So then you extract that there. Then you're like, okay, that triggers a whole bunch of thoughts. Number one, are you even measuring selling time, which AI can do for you? So we can benchmark it, and I want to see that in the boardroom. And then number two, let's list out the 25 AI initiatives we can do and which ones are most likely to move selling time, and let's go start doing them and see if we can move selling time.
so what I hear you saying is the AI use case in go-to-market is the administrative work. It's recording, it's like Granola connected to Claude, connected to your Salesforce instance, connected to Slack. Every call is recorded, all notes are recorded. Maybe AI drafts your follow-ups instantly. And to your point, as a result, like all of that pre-call prep, after call follow-up can be much quicker, maybe doubled or the speed of which can be doubled or the halved. And so the main use case is sort of like all of the promise of Scratchpad and Dooley from like 6 years ago of let the rep work in Zoom or in person or on a call, and all of the other stuff magically happens. That's one use case, and that makes sense to me what you just said, and I like that. And then the other place that people are using AI, but again, pick it apart, is uh, you could make the argument that it might show up in close rate because it would be, but it would be for SMB to mid-market businesses where you have better ICP definition and more personalized, but maybe that's still just personalized outreach, and maybe that still just contributes to opportunity creation and not necessarily to close rate.
I mean, there's one part of that, Sam, or just to add to it, which is where the company is in life cycle, because ICP, I think about that as well, of just like if you can get much more personalized and tighter using AI, your messaging is going to resonate well. And what your value prop is actually going to hit the right customer at the right timing. So you'd actually see it in the retention rates as well on the other side of it, of just
Okay,
like
so all
continuing.
these points are great. I think I should expand it because the way you guys are talking about it is let's attack all those numbers because Sam, I totally agree with you that the thing I outlined was really just increase in selling time, which increases the number of opportunities. I just say I do believe that that is the easiest one to double right now, and that's why. And I don't think people are even measuring it, selling time, whatever. So that spins off a whole discussion of like what are the most effective use cases. And Sam, you did a really good job of rallying off the ones like prep meeting, post-mortem, CRM updates, etc. Um, you do quote, and AJ, you as well, like, yeah, AI has made some significant advancements in refinement and optimization of ICP, which ICP in one way is if my team has like the capacity to call 25 new accounts this week, which ones do we call? And as an ecosystem, we've put that in the hands of a 22-year SDR, which is stupid, right? So like, and that's not going to necessarily increase selling time. That's going to increase probably LTV, honestly. And it might increase close rates, whatever, but like it really should drive LTV. And that's not even in the math. So we have to figure that out. And then there's like a whole bunch of other awesome, powerful use cases. Like one of our high flying companies is Letter AI, which is like basically allowing, it's replacing a lot of the work of the sales manager on coaching and just like literally devising diagnosing deeply which skill a rep should work on and personalizing training for that. And that doesn't increase selling time. It increases close rate because of skill assessment. And AI is really good at that right now. So yeah, it can be more comprehensive, but I think it's fairly easy. Your points are fairly easy to encompass into the revenue velocity formula because you're attacking each variable. Now, there's also like ICONIQ is rightly calling on close. Well, they called on close rate. So it does, AJ, it does. I don't think there's anything new there from ICONIQ because they were very focused on PPR, percent of
Yep.
reps hitting quota,
Yep.
and then they were quoting funnel velocity, which is encompassed in the revenue velocity.
Well, it's also
Or-
interesting because this was a January 2026. So I was looking at 2025 and the acceleration of the tooling and what we're using to do some of the things that Sam's talked about in the last 6 months has
Yeah.
exponentially changed. So I think there's probably an updated, but to read that back to you, Mark, and like if QuotaPath shows up our board meeting and Ryan Milligan, our CRO, he has a scorecard and his scorecard is a slide. Maybe it's on, well, not maybe. If he has revenue velocity,
Yeah.
selling time,
Yeah.
coach diagnosing, and then revenue per head, like those four things seem like they triangulate this
Yeah, I would
scorecard
say
for
like,
AI adoption.
yeah, if I would talk about this at board meeting, I would just extract it back to the impact. I'd start off with like, what is the end goal? And I think we need to, I appreciate your guys' advice. And like, do we focus on PPR or do we focus on percent of reps hitting goal? So it's kind of like, or you could
Yeah.
do both, but I don't want to like overcomplicate it. So I would start there and be like, hey, we feel like there's a massive impact to use AI to drive these, and we're not going to like hide behind our AI investments. We're going to hold ourselves accountable, and this is the way we're holding ourselves accountable. Now, as I look at that number, I'm going to extract it back to the revenue velocity formula, which is these four variables, and we're going to attack three of them. We're not going to attack ACV because we just don't think right now that, but we are going to attack um, uh, number of opportunities actively worked, close rate and sales cycle. We're going to attack those. And then I'm going to extract that for the number of opportunities. I'm going to attack that by increasing selling time. And by the way, we just started measuring selling time. And we have to talk about how do you measure selling time. I think we're working on some AI skills to do that. That would be a cool one for you to mess around with, AJ. But like,
Yeah,
I
I'm
think
looking at
every
that.
company should be measuring selling time right now as a benchmark and a way to influence. And then now that I've got that framed, these are the 25 things on the roadmap of AI and go to market. And these are the 5 that we're going to do this quarter. And we'll tell you in a quarter what the impact is, something like that.
The point around revenue per head or the percentage of reps hitting quota, it's a super interesting one. And I would almost think about it in the size of the sales team, because as sales teams have slimmed down, your efficiency, so your revenue per head should be going up naturally, but the percentage of reps getting quota, I mean, you're also probably managing out low performers or ones that aren't going to be adopting, should also be going up. I almost think that those two together tell a compelling narrative and story around it, because they ultimately tell where the go-to-market team is headed and the type of business that the team wants to build. Where the other metrics that you're mentioning, this selling time piece of it is really interesting. And it's like the one that I starred coming out of this. And how do you measure that? And in 2.5 weeks, I will have answered it on our board slide. So I'll send it directly to you.
We should
But
kick
I
that
think
around.
But the lagging indicator is, of course, the latter two. And I think where it's a conversation that I would come into a board meeting like, look, no, and this was last year, so I'll give you our stats. We were $140,000 of new business per rep, first new business on the sales team. We are about 170K today. Is all of that AI? No. Is some of that AI? Yes, for sure. Our reps hitting quota, however, is we're probably like 70 to 80% of our reps hitting quota on any given quarter, which I would say is probably close to best in class.
It's really good. Oh, it's awesome.
Yeah.
Your quotas
really
are too
good.
low. Sorry, sales team.
It's
I'm
funny
just kidding.
but Mark, we've raised our quotas.
I know. No, you're doing
year
good.
over year,
Yeah,
but we're going to continue to raise it. So that's why the ARR per rep has continued to climb, I think, as a function of that. So it's a complicated conversation, because you're also adding quota capacity and the financial plan as a mix of this, and you have to get that right variable incentives as well as a part of this too.
So before we go to Sam, I think the thing I'd pull out of that's really critical, AJ, is like that lagging indicator of PPR, percent of reps, is extremely hard to attribute directly to AI, and selling time probably is, as like, even though it is
that's the big one.
So I think that's why we have to like extract this back to the mini metrics that will be more directly impacted. But we're always going to suffer with attribution here in this whole analysis. Go ahead, Sam. Sorry.
No, it's a question. I have one comment and one question. My comment is, it almost feels like we have maybe another 12 months of this conversation before AI is just baked into like our expectations about how companies operate. My question to you, Mark and AJ, since you sit in a lot of board meetings too, is, have you seen companies that where clearly the inflection point of their growth was their aggressive adoption of AI in their go-to-market strategy, and they attribute, they were this before, I don't know, last year, and now they're this, and the reason that they say is because of their AI adoption? Like, do you see across the 70 or so board meetings you've been in, do you see a few examples of companies that were tier B that became tier A because of AI adoption?
Not on like a 2x, but on a 10 to 20%. And I still think we're so early. I think we had fairly like amazing breakthroughs in R&D and coding, just largely because like, I don't know, I don't really think AI was particularly, I mean, there's certain arguments of like coding is very deterministic, and it's like I think the most important thing is just like the people that enabled that coding revolution were the builders of the product. It kind of goes back to like one of the best selling products in the Salesforce App Exchange was DocuSign, because the salespeople used it and loved it. So it's like, I feel like that was a big driver, and now salespeople are just a little less connected to it, and it's coming. But I've been disappointed, Sam, with your question. It's a disappointment of across our entire portfolio, and it's not. I think it's not our portfolio. It's just the entire ecosystem, and even like, I'll go when Kyle Norton puts something out, or Gene at Versal, I'll call them up and be like, show me that. And it's interesting, but even they admit like some of the stuff they're talking about is still in an aspirational state. So we're getting there. I think by the end of this year, we'll see more of that, but it's just, we're in the moment right now.
Yeah.
Yeah.
AJ, I think this is probably a good time to go to our
Oh my
next
gosh.
segment.
Our next segment.
Wait,
our
can
next
I
segment-
just can I steal, if it's okay? Because I
You can
think this is
steal.
a really right on the edge, and I think I really would respect your guys' opinions here on this of like, can we just brainstorm for 3 minutes how you would actually measure selling time?
Yeah. So I started.
Sorry,
this-
Sam.
I started. No, it's good. I actually started to do spot checking, and this isn't the right way to do it because I should just Claude code an app for this. I started to spot check the go-to-market team. So it's not just new business sellers, but AM, our solutions team, and their number of customer calls that they have. And I've been doing that for a couple months. And what I have noticed is a trend. The trend is that the top performers are getting more and more, and this is again qualitative, more and more selling time as a percentage of their calendar, and the low performers are getting less and less. And there's a capacity conversation that I'm going to have with the team post this quarter, because we have an opportunity and inflection point, but we're like working on the optimization of efficiency, and then we want to grow 100% next year, and that's not hyperbole. I like literally think we can grow 100% next year, and to do that, we have to make sure we are as efficient and fit as an organization. And so, looking at their calendars and just literally doing the analysis and having Claude export and download all of it, I think is an easy start that you should be doing with the internal. Now, don't take that to the board right away. I would start to look at that with my CRO. We have a meeting next week, 2 weeks from now, before the board meeting, to work through that and see if that is a metric that we want to start to track and bring it to the board as like, listen, we're not doing anything. We're not making any decisions quite yet with this, but this is how we're thinking about AI adoption as it relates to selling time. That's where we're starting.
Yeah, that's what I was thinking, was either like whatever you're using as your call recorder, whatever, Otter Fixer, like Zoom, Girl, or whatever, just like you would just run the analysis against each rep and how long that's running, and that would be the numerator. Now, of
Yep.
course, like devil's in the details. How do you know if they're talking to a customer or not? Right. So
we don't record with
I would
Gong. You
use
don't
the
record
calendar.
internal meetings. So
Yeah,
it's
I would
Okay.
use
really
the
easy.
calendar and take out
Yep.
any internal email addresses and just look at external email
Calendar
addresses.
could be good. What if it gets canceled? But I agree. Like, I think these are all the devil in the details debates, right? Like, so sure, you can run a cool model, be like, okay, use the calendar to figure out who it was, then use Gone to figure out if the meeting occurred. And then that's the numerator. And the denominator, do you just use 40 or 50 hours a week? Do you like look at when they
you
log
need a
into their...
denominator? Why do you need a denominator? You can just compare gross talk time.
That's fair.
I don't think you.
That's fair, because you
I
have to
do
get
think you-
down to a percentage.
The
Yeah.
only
Yeah,
thing
that's
that Mark's
really good.
thinking about, I think, is a ratio, which
No,
is
that's
like,
good though. You don't need it.
Well, I would just say it's
My
like, is
top
there a
reps
way to
talk
look at
9
this
hours a week.
normalized?
Go ahead,
Mhm.
AJ.
No, if there's a way to look at it, it is normalized data. Maybe it is just the gross number, is just the hours. Does
Yeah,
that become the
instead of
metric?
saying 30% selling time, we just say 25 hours of selling time.
VCs love ratios and percentages, though, Sam. So
No, that's a good point. That's a good point, though, Sam. It's just like
The
how many
good
hours
news
of
is
selling time
that-
per week.
Yeah, I
easier.
mean, we all work in the same quantum field of time. So
Yeah.
that is normalized, like
Yeah.
everybody.
How do you do it with your outside reps? And especially given that I think like we're outside is kind of in vogue right now. Like,
well,
how do you do it there?
enterprise, it is in vogue. Enterprise is a little difficult. I mean, I think you can definitely still do the same thing. You
Yeah,
just
they
do the
still
number.
have those recorders. Like people do
Still
have
selling
Gorilla run
time.
on their phone, and they do have those new cool like things, the cards you can bring. I don't know if that's
Yeah.
cool. Like people are doing that, but
The question I have for you, Mark, is do you make this a part of their comp? Do you incentivize this, or is it too easy to game?
probably that's a really great question. Haven't thought about it. I love it when I get a fresh question. My instinct tells me no, and it goes back to like I remember hearing stories that like all the way back to like I hired a bunch of monster.com reps in like 2007, way back in the early days. And they told me these horror stories about how they were comped on the phone. The phone was just like a new, like we were closing on the phone, right? So they're comped on their phone time, and they literally were passing around 1-800 numbers to call just to get your phone time up, even though it wasn't even a customer. So I just feel like I think it's very dangerous to comp on lead. I'd run sales contests on it potentially, but I think that would be my instinct, is like it's dangerous to put comp on it.
Yeah. All right. Well, you will get a board slide from me, and
Yay.
July 15th is our board meeting, and it will be on selling time. And I can't wait to work with Ryan. I'm like, Ryan, figure this out. Mark said we need to like any good
Cool.
CEO. Okay. We do. Yes.
Play
it
your
is time
game.
for our next segment, Sam.
Play
and
your
I get to
game.
host it, which is my favorite. And this is Quiz Pro Quo. All right, good. We did it. We crushed it.
We did it.
Neil's got
I'm not. The
fix
kids would
that
call
for
that
us.
cringe, AJ.
Every week it's cringe. So I had a conversation with a friend of the podcast, David Spitz of Bench Sites, and David has a ton of great data on companies and public companies. And I was digging into it with him yesterday, and I was like, oh, this is going to be great because I am going to completely stump Mark and Sam tomorrow with this data. And so I'm ready to go with it. So first question is on the Rule of 40. And there's been a lot of conversations, specifically at the M&A, on Rule of 40 for companies and what does that need to look like. And I am going to ask you, which of these companies has the best Rule of 40? They're public SaaS companies. Okay.
Mhm.
Ready? You have Snowflake, Palantir, or CrowdStrike.
You want me
I
to
think
go,
it's either
Sam, or you-
Palantir
That's the
or
question. You
CrowdStrike.
guys have to answer it, not me.
Yeah. I'll go first, or you go first, Sam. What do you
Well, you
say?
can talk it out
we have
loud.
one unified answer, Mark, but we typically defer to the guest.
Oh,
Yeah,
good.
the guest is
I would guess Palantir.
Yeah, I would guess Palantir too.
Palantir is correct. See, I get easy questions to you guys.
No, that was hard. I mean, the way I thought about it was, I mean, government and defense is just like a whole. I mean, these are huge contracts that are super sticky. Yeah, I just like tremendous respect for the business. I think it's pushing.
Well, any
the
guesses
entire
on what their
movement in
Rule of
defense.
40 number is?
72.
I would say 55.
55. It's
I said
137. 137%.
How's it break down between EBIT and growth? Do you know?
I mean, but the funny thing is, it's up 81% from a year ago. 81%. 2 years ago was 33%. So the AI wave for Palantir has been immense.
That's
as
crazy.
discussed.
That is crazy.
Yeah.
Wow, what a business.
What a business. Okay, question number 2.
I wonder what OpenAI's is. Negative 5,070.
Yeah, exactly. Well, Austin did break that up. That was one of the topics to talk about their negative. So which of these companies has the highest ARR per employee among traditional public SaaS players?
Mm-hmm.
Is it A, Adobe, B, Salesforce, or C, Twilio?
I would say Twilio.
I'm going to say Twilio too.
Man, I'm giving you guys softballs.
Yeah. I mean, the breakdown there is like PLG, very, very product led. I feel like with Adobe, I'm like, okay, now I'm dealing with like 40 years of like
exactly.
legacy
Two
crap.
archaic organizations.
Salesforce is known to be a body shop, like hire 1,000 reps, fire 200, just like Twilio's product led.
Well, okay, so same.
A lot of humanless revenue. You know what I mean?
What do you think? What do you think that revenue per FTE is?
430K.
600K. This is gonna blow your mind, and I got to double check this. 5.6 million.
Oh my God!
That's
wow,
direct
that
from
is
David.
Crazy.
Isn't
That's
that insane?
awesome. Another
That
good
is crazy.
business.
Well,
Yeah.
I think Anthropics is higher, and maybe Lovable.
Is NVIDIA higher than that? NVIDIA can't be higher than that, can
I
they?
don't know. They've scaled up a lot of people, but still they're printing money like crazy. But yeah, that's crazy.
Yeah,
That's
that's
crazy.
What a business. Okay. The last one's on go-to-market spend, which has changed quite a bit since the 2020, 2021 ZERP days. What's spending now as a percentage of revenue versus back then? So is it A, 31% now versus 40% in 2021? B, 27% versus 35%? Or is it C, 40% versus 20%
All right.
in
So remember,
2021?
is the first number now and the second number
Yeah,
is
the
Yes.
first
then?
number is
Okay.
now.
And then who are we measuring against? Like, what's
This is
the?
all public SaaS companies, the median
Okay.
SaaS companies.
I would say it has gone down. And so was there two options to have gone down, or just
Yeah, the
one?
A and B, A and B have gone
Okay.
down. So 31% versus 40%, and then 27% versus 45% in 2021.
I'm gonna say that one.
Yeah. I'll go A just for kicks. Yeah.
Oh, you're going A? Okay.
Yeah, sure.
So A is the answer. Yeah. You got it. Sam, you were wrong.
I mean,
but
who
we got
knows?
it
That
with
was a
guess.
crapshoot. But like,
That was a
yeah.
crapshoot. That was an Austin type question. So 31% versus 40%
Tough.
in 2021, which isn't gone down as much as you would expect with all this talk of optimization around
I know.
efficiency and AI.
I
And I
know.
don't know, like, is that including, like, where does AI fit into the COGS?
I
Special
personally
OpEx?
don't think it's big. Like when you talk to a lot of these, and I have like, as you guys know, like I have 1,000 LPs, and they're working at all these companies. All the new ones, Anthropic and OpenAI, and all the old ones like Adobe and ServiceNow, etc. And they're just general narrative is like we're cutting like crazy with the premise that AI offsets it, but it's not offsetting it. We're just like driving our people like crazy. You know what I mean? Like there's a little bit of fat cutting, but there's also just a lot of like, the AI hasn't caught up with it.
Yeah, there's in
So
momentum
yeah,
as
that would
well
be
is
the
still
general
there.
anecdotal narrative, AJ.
Yeah.
But
All right, topic 2, which again, we threw all of Austin's topics out the door. And so, Mark, we were talking right before this, and you made this like general statement around is it better to be a fast follower today than an incumbent? And could you be two guys out of MIT? I just
Yep.
picked a random university, of course, Mark. MIT, to build something and fast follow on the coattails of a company that is already blitz scaling or scaling like crazy. I don't want to say blitz scaling because that means headcount
I
a little
think
bit,
it's
but
fine. I think that's
crushing
a
it.
good word for here. So like that, yeah, that's so if I could just spend 2 minutes framing this both sides,
Yeah, that
and
would
then
be
let you
helpful.
guys like chime in on like, hey, maybe you forgot about this perspective, or like, what about this, or I feel like this is more weighted. So first mover versus fast follower copycat. First off, I personally like kind of invest into this because as an investor, it's important to note where you have conviction against the consensus. And the consensus across most of especially our world, the B2B software ecosystem, both in venture as well as the founders, is that the first mover always wins, has a massive advantage. And I think the blitz scaling work is a good one, AJ, Reid Hoffman and Chris Yee, where they kind of make that argument. Now, unfortunately, or just noting, if you spend some time in Perplexity or ChatGPT or wherever and just say, hey, what are all the rigorous studies around first mover versus fast follower? I can't find one that says first mover wins most of the time. Like they all say fast follower wins most of the time. I would say if I were to average it, I would say it's about a third first mover, 2/3 fast follower. Okay, so that's just like some rooting there. Now let's break down the advantages and disadvantages of both models. First mover, and building off the blitz scaling work, you get to the headline first, you name the category, you're associating your vendor and brand with the category, you get the first big logos, the first major customer studies, all the top engineers join you, and the tier ones give you the biggest check that scares everyone else off. Okay, so that allows you to propel.
Yep.
The disadvantages are relative to the fast follower, you have to burn a ton of money figuring out the product. Sometimes you're ahead of the market. You have to evangelize the market. And sometimes you raise at a massive valuation that you are under pressure to grow into, which puts you in what they call ACV jail, where you can't optimize your price because you just have to maximize the crap out of it to grow into that valuation. Okay. Copycat, exact opposite. It's going to be hard for you to raise from a tier one because everyone's afraid of the person that's already backed. You're kind of like the also ran second person. But if you run a pure copycat and study what Rocket Internet did in Germany 15 years ago, they made a lot of money doing this, where they just literally copied the US winners in the German market. Okay, so that would be the play here. And this is all driven from like, I did this like speech to one of those open claw like hackathons
Meetups.
last week at
Yeah.
MIT. And it literally like one kid was in high school. You know what I mean? Like everybody else was in college and they're super smart and they're kind of running this. And it's like, I'm literally just going to, there's a company in name a category that built a product and they raised 400 million. Their last round was $5 billion. They're doing about 100 million in revenue. So they raised it, whatever, 50x. And everybody says they're way too expensive. It's not a hard product to copy, especially with R&D today. It makes it a big why now. I'm just going to copy the product and sell it for 70% off. And my only advertisement is Acme Company at 70% off. The same thing. And so like, that's kind of the play. And they're arguing that there's a massive why now around it today that didn't exist 5 years ago that I think has 3 or 4 dimensions to it. The first one is product development cycles are 10x faster because of AI. So copying product is just a lot easier. Number 2, we've never seen higher valuation multiples for the first movers, which puts them in ACV jail. And then number 3, even these companies that were started 18 or 24 months ago, they built their product on an architecture that is already outdated.
Right.
You know what I mean? So there's that whole piece. And then the final thread is like, well, if they do that, then will someone just copycat them too? Right. So like there's that whole thing. But yeah, that's the debate.
Let's go through some examples. So first of all, you could say that Claude and Anthropic are the fast follow to ChatGPT and OpenAI.
Right.
And they've now surpassed OpenAI, I think, in terms of revenue and certainly in terms of B2B usage. Legora and Harvey is a good one. I don't know. They're both big, but I know that Legora is growing very quickly. What are other good examples recently versus, Salesforce, I would say, is the first mover when it comes to CRM. And I would say that
There is
they
one
won that.
There are other
early, but
clouds out there. I'd have to study that one, but I don't think, I mean, obviously the easy ones, like historically Slack and Zoom were nowhere near the first in that category. On the B2C side, like, on the browser side, the search engine side, the iPhone side, like none of those were like first movers. And I even think like if you study deeply, like Workday, Salesforce, even ServiceNow, I don't think those were the first major cloud attempts that were funded. But then more recently, I don't know. I don't know if we've really. There's a reasonable argument that some have tried and failed more recently. But I don't know.
It's a really interesting premise. And it's also why you're going to see the rise of, one of the reasons you're going to see a rise of AI tech-enabled services, because in the absence of product, all being equal, if you're delivering a solution, let's take comp, for example. If I told our customers, like, listen, I'll just take comp right off of your plate altogether. You don't have to think about it. You don't have to deal with it. It's just, we handle everything 100%. Not 100% are going to opt into that. But that product market fit and demand, because I know what people think about the ICM space will be quite high, I should say, knock on wood.
Yeah.
And I think you can't have a fast follower that's following that model. So the traditional SaaS companies that have put hundreds of millions of dollars, like Gainsight, into CS, into evangelizing the category, we have seen lots of fast followers in that category, but I don't think there's been a great example of anyone that's like risen above Gainsight. Now you could argue that the TAM on that category, or just the category in general, wasn't interesting enough to create a fast follow type of organization. The one category that's playing out that will be interesting to watch, it's just kind of a sleepy one, but a pretty big deal, is ERP and NetSuite.
Sure.
And there are two companies that we deal with in our spaces from a partnership standpoint, Campfire and Rillet, that have gotten a lot of money poured into them for AI ERP.
Yeah.
And it's not in the CRM because everyone wants to be in the CRM. And the ERP arguably is just as big of a space. Like, I'm sure the TAM for CRM is much bigger, but it's still ERP is quite a behemoth, which is invoicing. You're running all of these contract. How do you keep track of all of your contracts at scale for organizations? And it'll be interesting to see
All
that
right, so
play out
let's
as the fast
I
follow.
want to make sure that we frame in it. We can go in any direction, but I wanted to like make sure I was clear about the intention here and make sure I don't think you're saying this, AJ, but I want to make sure like I didn't intend for us to evaluate traditional last generation incumbent versus new attacker, which is a whole different debate. And we've had that
Yeah.
debate a lot. My intention here was to evaluate the recent movers, like who's been funded in the last 2 or 3 years as an AI native new company with big valuation, and how vulnerable are they to a copycat,
Yeah.
right? So not necessarily Gainsight being disrupted by replacement, ServiceNow being disrupted by replacement, but more of like these big brands that you're hearing about that were funded in the last 2 or 3 years. Are they vulnerable or are they the winners? And I think like so far, but both of your dialogues, something I didn't mention in my own initial commentary, which is also another interesting conversation, is it tests the durability or moat of that company,
The
right? So
initial,
I'd
yeah,
agree
the
with you.
initial.
Like, I would be way more bullish on the moat of Harvey and Legora, even though it's somewhat being tested, because I believe that the end market law firm cares a little less about price optimization and feature optimization and cares more about what Morgan and Morgan is using. And if Morgan and Morgan thought Harvey was good enough for them, that goes a long way. And that is, if you extract that back down to Michael Porter's 5 Forces Barrier to Entry and his work on moat, he classifies that as almost like a brand moat, where you buy it because of the brand. And I think today, like Pat Grady at Sequoia talks about as trust. He's one of the lead investors in Harvey. And so they're kind of the same thing, is like your moat is that there's this recognition of Harvey as being a trusted product for all the big law firms. So if I'm a law firm, I'm going to use them irregardless of the competition, feature set, and price. Okay. And I think that translates well to a lot of end markets that are not technical. Right. So I think that's part of what you guys are saying, is there's certain ones that have a high moat and I wouldn't want to copycat them.
Well, that hackathon that was it a hackathon that you were talking? Okay.
Yeah.
So they did they present what they built from any of these
They're just
categories?
so
Build the
early. I
X of
mean, literally,
Y.
like I went and talked to them on Wednesday and they had started building this stuff on Monday. I mean, they're
'Cause I'd be
building it
curious
on
if
OpenClaw, which is cool, right? Because like there's a
yeah.
whole nother set of like interesting vulnerabilities that are like, is the LLM even a utility or does it have a moat? And if you build on like, especially the obsession in the last 6 weeks on token optimization and compute optimization, like that's an opportunity for a copycat to just really generate a lot of efficiency, that the folks that built 2 years ago don't have.
Do you think so they'll present this at some point, and I'm sure you'll talk to some of these students and they'll become founders of this. I guess my question to you is, are you looking at any companies right now? Have you
Yeah,
had
I've already made
uh,
one.
you made
I'm not going
one
to
bet
say
on
one
it?
yet because I don't want to poke the bear yet.
That's
Well,
awesome.
that's also interesting as well, because when I think about it, it's like when I started TrendKite, I was competitive directly to Meltwater. And the question I always got asked is like, "Oh, are you afraid of them?" I'm like, they wouldn't like. I'm a startup. I'm moving much faster velocity wise. They couldn't even like keep up on a product roadmap. But that's changed a little bit because you have these incumbents that are just last year, the Harvey, Legora, whatever. But pick that for any other industry. If they do feel like they're getting poked, they should be able to to change course pretty quickly as well. So even that like
Yeah,
startup
well,
mode is a little bit
that's
disintegrated.
it's a good point, but I think that's where there's some vulnerability. And guys, let's just so you know, like this isn't my entire investment thesis, nor is it like I don't even know if
No,
this
it's an
works, right?
interesting
It was just
discussion.
debate,
It's a
right?
debate.
Just frame it. But like
Yeah.
my counter to that would be I would take advantage that they're in ACV jail, meaning because they had to spend so much money figuring the product out, so much money evangelizing the category, and because they had raised at a 100x valuation multiple, it would be very difficult for them to drop their ACVs by 70%. I mean, you're talking about potentially a company that has $100 million in revenue with an ACV of 100,000, and two kids from Caltech are now offering a very similar product for $15,000. I just think that's very difficult to pivot to.
You know, that's interesting. This is what Adam Robinson's doing with Molt sets. He's trying to dramatically undercut ZoomInfo, Apollo, and all of the contact
Yeah.
database information, all the data information for $30
Exactly.
a month, and just say, I don't care.
Yeah. And
Yeah,
he's
I
at
mean,
10
that's
million in
interesting. I
ARR.
would say, like, let's take that one apart. What doesn't necessarily apply in this case is ZoomInfo and Apollo don't fall into the 100x valuation trap, right? They're more of like, I think that's more probably a little more of an incumbent, like a 2015 incumbent to now, which is that's a whole other opportunity. And I also like the moat durability. Everyone says proprietary data. You would think ZoomInfo would fall into that, and it's you know, if they're having success, and obviously the market isn't really that bullish on it, given how we're poor Henry, good friend, but like he'll pull it off. He's an executor.
That's for
Yeah.
sure. AJ, is it
Um,
not? Should we go to Bulls versus
Bulls
Bears?
versus
Okay, so
Bears.
I'll
Well,
disclose who I'm going after on the.
yes.
It's Quota Path. Just kidding.
Oh my
Okay, well,
gosh.
I'm just.
I'm long
That's
Quota
okay.
Path. I think
Your
everybody on this call. So
Insight is already
Quota
invested
Path
in
would be a
4
tough one
different.
to
No,
go
I'm just
after, I
kidding.
think. Yeah, I think you guys
No.
are pretty well picked. Okay.
Bulls versus Bears.
Speaking of the ZoomInfo comment on you mentioned, and this is a little bit of a bulls versus bearish on that regard. And so I first want to make the disclaimer that this is not financial advice. And Mark might abstain from answering some of this, but I'm going to ask it anyway. So in this segment,
Yeah.
I'm going to ask a question. I'm going to ask one question because we're running short of time, and both of you have to say whether you're bullish or bearish on it. So yesterday, Jason Lemkin had a tweet. You all might know what this is.
Sorry, yeah.
That HubSpot is at $3.5 billion in ARR, which I also think they have like $2 billion in cash as a part of that. but
Right.
There's a lot of numbers in there, growing 23%, and it's trading at $8.8
I
billion
know.
in ARR.
Insane.
That's 2.4x, 2.5x,
I think Clay
whatever.
is trading higher than that.
Yeah. So this is either the most mispriced software stock of all time, or AI really will be the death of everything software. So the question is specific to HubSpot. Are we bearish or bullish on HubSpot long term?
Yeah. So because of my connection, I'll say it again here. I'm just on the advisory board. I have no inside scoop. I haven't had inside scoop in 12 years and what happens in the board meeting or any insider numbers. And I have someone else besides myself manages my entire financial portfolio. But I would be very bullish on that, as well as some of the other peers.
Sam, what are you?
I agree with Mark.
And
I think
this is all the time frame. Like, I think it's a buy right now with an evaluation of a sell, whatever, 6 months, a year from now, 2 years from now. Over a 10-year period, that's a different question.
Yeah. That's a different question.
But in terms of
gonna
just
take
this stock price right now, it's a
I'm going
buy,
to take a
in my
little bit of a
opinion.
counter. And I
Mhm.
look, similar to Mark, I know a lot about HubSpot as a HubSpot Ventures company. The bearish piece of it is more on what they've said publicly, and more around the vision and more around executive changes. Those two have been in flux, and they've been very public about that over the last year. And so my sense, objectively looking at it, is it's a company that is still really trying to nail down what does a customer really want, and how can they articulate it best. They changed the name from Inbound to Unbound. They had this marketing loop thing that Inbound did release last year. I don't know if that's gone anywhere. I haven't heard anything. Kip Waldner was like really big on it last year. And so I think it has a little bit of a vision crisis personally. And so that's the bearish
I would
part
agree
of it.
100% with that. But the core business seems mispriced for
Yeah.
for the performance that it's generating. Okay, last question, bull or bear for both of you on Halligan coming back as CEO at some point in the next 18 months.
Wow.
Ooh.
Yeah, I mean, I would be bearish. I know him obviously very well. I know Yamini well. I don't know. I just think like when he puts trust in someone, he puts trust in them. He had that accident that he almost died, you know,
Yeah,
and I don't know if he'd want to take it on. Yeah.
fair enough. Well, you also
Uh,
might not want to take it on because, you know, it's like the reputation is it's
Yeah,
like Michael Jordan
he's
playing
already
for
done
the
his thing,
Wizards.
right?
Yeah.
Yeah.
I won't talk to Halligan and HubSpot specifically, given I know both of them not anywhere near as well as Mark does, but know both of them. But I am bullish on founders coming back. Look at Finn and Intercom.
Sure,
And
sure.
and setting the
Mhm.
vision and doing it in a way and just kind of transforming the business.
Yep.
It founder mode is a thing. And so that if that's a part of it and the vision's a part of it, I'm sure there's some calculus to
I love
conversation.
that, and I just want to say, I just want to like go like just put something out there to help the ecosystem. I thought it was Paul Graham, right? His memo
Yeah,
on
PG said
founder
it.
mode.
Yeah.
That was brilliant, wonderful. I think in some cases it was misinterpreted that could hurt the ecosystem. Where like I agree with the intercom situation, or even like what's happened in any of these companies, Zoom Info, HubSpot. Like you need to go back into founder mode, which means like you know, you're no longer stretching the spreadsheet. You're going back to like experimentation and pivoting and that kind of stuff. Okay, beautiful. I think there are a lot of founders that interpreted it as I'm never going to hire an executive team and delegate that function to them. I am always going to run this very micromanaged command and control organization. And I think that's a problem.
Yeah.
So just
Agree.
like be careful of the application of the memo.
Yeah. I think
For
that's
sure.
that's it.
Mark,
Sam, you want to take us out?
yeah, I just want to say, Mark, thank you for being a friend of QuotaPath, of Pavilion, of STA, and of Topline. We appreciate you and we love you. AJ, we feel the same
We'll send
about you.
swag. We're gonna
We're gonna use
we're gonna
some
set. We need to send swag. I need to get the A+ accolades next time from Mark, given that Sam got all the A+ accolades. So I'm
Oh,
What A+
I'm excited.
accolades did I
what are
get?
you talking about?
I
You said you're doing
know.
great with the company and all that stuff.
I'm
and,
only
like,
kidding.
awesome,
But seriously, do need to send you some swag, Mark.
All right.
thanks. Yeah. No,
Great
thanks you
seeing you,
guys.
buddy.
It's always a lot of fun to jam with you.
Yeah.
Thanks,
Thank you.
Mark.